Hey, what's up, everyone? This is Trader Tim from EminiMind bringing you another monthly market analysis. As always, trading futures, options on futures, retail off exchange. Foreign currency involves substantial risk of loss, is not as suitable for all investors. Past performance is not indicative of future results. So, lots going on in the markets. Last week we did a live trading session on what was a little bit of a lackluster morning, but turned into a pretty nice day. And one of the things that I want to start before I go through some trade setups from this morning is the last couple weeks we had this kind of V reversal, and that brought us right back up to the prior highs, at which point the bulls have the opportunity to break highs. A lot of times when I'm doing my kind of bigger picture analysis, whether it's starting the week or looking at the month, I'm trying to think about if I was if I had a big long position on the table, how would I be sitting where we're at in the markets? Or if I had a big short position on the table, how would I be sitting or how would I be feeling? What thoughts might be going through my head in the current market conditions? So, looking at the little bit bigger picture, the prior highs of the all-time highs here on the S&P are not too far away, but in this push sideways, we've just had a struggle between bulls and bears. And we talked about this widening formation, which is a little bit smaller now on the daily chart. But what we have is a struggle between the bulls and the bears to really gain momentum in any one direction. And it starts with very tight ranges, small candles that start to widen, if you will. So kind of the opposite of the descending triangle, where we have a wide beginning and then we get a higher low, a lower high, higher low, lower high. It's kind of like a bunch of steam is building up, pressure right at the apex, and then boom, we get a very strong trend in one direction. Well, with the widening formation, where we start real tight, we get some consolidation, and we make a move lower, then a move higher, and then a little bit, couple more days of down up, where we're kind of widening, making a high and then a lower low, then a new high and a new low. That kind of leads to indecision or more fight with the bulls and bears. So the resolve is similar, where we get a big move, but that move is then typically counteracted with a move in the opposite direction. So the big body candle down here was Thursday's trading session, and as we were going into the session, I was saying how it was very likely that we'd have some fake outs, we'd have quite a bit of back and forth where we would make a new low, and then the bulls would come back in and push the market higher, but then the bears would come back in and push it lower, and at the end of the day, we were able to get some trend in the downside, followed by a basically taking it all back on Friday to the upside, and then today, once again, pushing back down to the downside. So this makes it for some really can be a little bit volatile intraday to trade these markets. So let's look at some of the setups that we had today and kind of talk through how you can adjust your trading when you have this kind of market condition. So using the tick chart, like I always do here, especially when we're in the smaller, or when we're in these choppier daily setups, I'm not looking to take big daily levels because there's not really a trend established. So just going back to this morning, earlier on the euro, we had a nice long setup, kind of off lows. We had kind of been moving down and sideways throughout the morning, the early morning, but then right around the NYSE open, we were able to get a break of the prior swing high back here, and then pull back to the 50%, and then make a nice move higher. And on Thursday, during the live trading session, I was talking about how the euro, because the ranges are so big, you can get away with just using a really tight stop, 1 pip below each candle, and as the next candle forms and breaks out to a new high, just take your stop and move it underneath the next candle. So at the onset of the trade, I put my stop at -8, and as soon as we start to, in this case, go in our favor, then since we're long, I'm going to tighten my stop by lifting it up, and rather than just setting some sort of arbitrary target on the euro, because as you can see, you get these long trending moves on the euro where you can really capitalize a lot once you get into a trade and it starts to go your way. As opposed to the ES, where we can get a lot more back and forth and the ranges are a little smaller. So my trailing stop strategy for the ES is to trail the swings, if you will. So there was a nice trade around 920 over here, and then I'll back up to the morning. But if you were to simply get into a trend by waiting for a break of the prior swing, pull up the 50%, and then get into the 50, what I like to do on the ES is to trail my stop above each swing as we make a new leg lower. So I would start with the initial entry up here, stop -6, and then we move down, make a new low, put my stop above the next swing high once we break the next low, and then just keep doing that, move my stop up to or down to the next swing high, and then just keep doing that until the market gets some sort of trend change. And in this case, this morning, we had a really nice trend, lower into the basically in through the lunch session before we started to kind of get some sideways action, and that's when you get taken out. But nice trend on the ES. Another strategy, because just as we were discussing on Thursday during the live session, there are a lot of times where it can be a little bit hard to see trades in hindsight if you're not paying attention or looking at the markets during the day. So if you just go back in hindsight, sometimes you miss trades, or you might not see things as they actually happened in the morning session if you were trading live. So I like to give the first 15 minutes a little bit of a breather. And on Thursday we kind of jumped in right away. We were talking about the setups, and things were moving pretty fast, so we had a little bit of activity, but we didn't really have a whole lot of follow through in the markets, so it wasn't super exciting. But I wanted to highlight a couple of setups from this morning that kind of outline the concept in a way that it may be a little bit more difficult to see later on. So right at the open, now this is kind of within that first 15 minutes. I like the markets to kind of settle out, but we do have a setup here where we have a low, and then we broke the prior swing high by making a high up here. So valid trade just in that caution window in the first 15 minutes of trade, but getting in at the 50 and then letting the market go to new highs, bringing your stop up underneath the low, and then you can see we kind of came back, chopped around, and then ended up failing or breaking down. So yeah, the trade went our way. If you were to get super aggressive and trail each candle, you'd end up tightening your stop pretty aggressively and taking away a small profit. But we're not really concerned with small losers, small winners. Those just kind of negate themselves. We want some trades that are going to trend and move in our favor and give us those little bit bigger winners. Not necessarily that we're looking for a home run every trade, but we don't just want to be taking +6 or +4 and then calling it a day. So what you can do is combine a stop with an arbitrary target. One that's pretty popular that I'll use sometimes is the -23. If the range is somewhat decent, here we had an 82.50 up to an 85, so 2.5 points is not too bad. And so you can put your target up here and then look to trail your stop at the same time. So that's kind of a way to contain both sides of the trade. And when we get into these real choppy environments, that can be helpful, especially when the ranges are pretty big. So then we started to break down, and you can start to see the retracements set up where we break the low. And you'll see as we kind of get outside of that first 15 minutes, things start to get a little bit clearer and a little bit cleaner, if you will. So we had a low for the morning back here. We make a new low. So just pulling from highs to lows, getting short at the 50% retracement. And then as we break down, you can start to move your stop from -6 and then down to one tick outside the entry candle, and then down to the swing high, down to the next swing high. Or if you prefer, throw a target down here at the -23, just round up a little bit. And so in this case 77.50s, and your entry here at 81s. And then that takes you down. You can still trail your stop at the same time, but as we get down to the -23, then you take your profit and you move on to the next trade. And so the nice thing about this smaller tick chart trading is that you can kind of trade both directions, if you will, and you've got very small stops, so there's not really much harm in being wrong. But if you limit yourself to 2 stop outs, that ensures that if you do get into a situation where the market is just crap or it's not really moving that well, you cut your losses on the day, and you really haven't done much damage because if you're using a -6 tick stop per contract, that would be 6 and 6 is 12. So how many winning trades is it? Pretty easy to get a +12, and just keeping going here on the day. We broke the swing low, and so drawing from highs to lows, had the 50% entry up here, and then broke down, swing high, break down, new low, new swing high, and just trail your stop. And the market, when you get into these kind of trends, it's easy to take 5 or 6 points using a -6 tick stop. So that's kind of why I prefer a pretty tight stop, but also a small time frame. If you're trading a daily chart, and you're just using a 6 tick stop and just throwing trades out there, it's pretty easy to get stopped out. But if you're using a smaller time frame, kind of keeping in context of what's going on in the bigger picture, you can get away with a tighter stop. But then at the same time, just because you're using a tight stop doesn't mean you have to use a really tight target. So I hope that was somewhat helpful in terms of looking at how you can adjust your trading to these kind of conditions where we get real choppy daily candles, and how that transposes to the intraday chart. So looking forward to doing more live trading sessions, maybe at least once a month, maybe a couple a month. Sometimes we get into situations where the days are slow, but then other times we get a lot of interesting things to talk about, and it sounds like they can be really helpful in terms of just kind of sitting in and watching another professional trader kind of have at it. So with that, if you have questions, feel free to email me over at the blog, EminiMind.com, and then my email is just tim@EminiMind.com. Thanks, and have a great day.